Okay, this is the last time anyone talks during this conference, so I just want to thank, on behalf of everyone here, I think Jim and Avner for putting on yet another really great conference. This is always one of my favorite conferences of the year, both in terms of just the people that come. I mean, looking around the room, there's people that I've been coming to this conference with for probably 20 years, almost every year. And it's good every single year, so thank you so much for putting it on. Thank you also for putting a real estate session into the conference. I don't know if this is the only time it'll ever happen, but hopefully this is a feature of the conference going forward. So discussing this, I mean, there's no Swedish connection here, so I'm not quite sure how we got put on the program. I think this is more just the fact that Jacob and I are friends and co-authors, which seems to be the other main criterion for picking discussants here. So Jacob discussed very, very clearly sort of what's going on in this paper, and real estate is a huge fraction of the US economy, or the world economy. But what we know about the price dynamics of real estate is fairly limited. Now, there is quite a literature, certainly in the real estate field, there is a literature, but as Jacob points out, it mostly sort of assumes that things just follow a geometric Brownian motion and kind of leaves it at that. There's quite a bit of literature on predictability, for example, but there's not really a very sophisticated look. At the same time, they're really very important, and Jacob pointed out some of that. When we talk about mortgage valuation, something that I've been thinking about a lot during my whole career, the price of any or any real estate derivative, basically, the dynamics of the underlying real estate are crucially important for determining what's the value of any security whose cash flows depend on that, and yet we don't really know what that is. More recently, bank stress tests, and there are some rumors that house prices had something to do with the recession that we've just been through. When we're thinking about what is the systemic risk of an institution, or what's the likelihood that the economy goes into free fall caused by real estate, the properties of real estate prices might well be relevant in thinking about that question. So understanding this question is a really big deal. The problem is it's a really hard question to answer, because unlike stocks, if you're used to just dealing with stock prices, fine, maybe you can't get prices every 22 seconds, but you can certainly get prices every day. Real estate doesn't trade very frequently. On average, I actually don't even know what it is for commercial real estate, but for residential real estate, maybe on average a house trades every sort of 5 to 7 years. It varies over time, but something in that region. And that poses a problem by itself. I mean, so for example, the usual thing that we do, and I'll go through this just because I will. What do we do? And the problem is you cannot see what you're interested in really are the dynamics of the prices of an individual property, and that's kind of an important point. I mean, most of the contracts, and Jacob made this point, most of the contracts that we see are written on a property, whether it's a house or a piece of commercial real estate. So what we really want are the dynamics of each individual property. And yet when you actually look at the data, and I've looked much more at residential property than commercial, most properties that are in your sample, if you're lucky, they sell once. And properties that sell more than once are pretty rare, and properties that sell 5 or 10 times, there's something weird about them because they shouldn't be selling that often in any given period. So it's just a very different environment. So what we tend to do is we construct these things called price indices that at least give us an idea for the dynamics of what we might call the average property. Now, of course, how good that index is depends on how good the assumptions were about the underlying properties that you put into the index in the first place. And what we do in the US, and to give you an idea for whether I think these are a good idea or a bad idea, I'll point out that the US is, I believe, the only country that uses this kind of index. We use something called a repeat sales index. So let me just sort of briefly go through what that is. And this is one of the sort of this is the methodology behind one of the standard indices that we use. This is what's now the FHFA, Federal Housing Finance Agency, used to be the Office of Federal Housing Enterprise Oversight, or FAO. So essentially, we write the price the log price of a property. Have I got, which one is that one? That one. Write the log price of a property as at time t as some time-specific constant. Call that the index. That's kind of that's the index level that we're looking at, sort of the price of the average property. And then there's some noise around that. And so h is some Gaussian random walk, and n is additional white noise. And so then if you think about what the total, if I look at a particular property and it sells at periods s and in period t, what's the total return that I observe? What's the price at time t minus the price at time s? What's that equal to? Well, it's that thing at time t minus the same thing evaluated at time s. Okay, great. But I can write that down in a slightly different way. It's equivalent, but I can write it down as the sum over all of the time periods in my sample of this thing, beta plus these two components for each period, multiplied by this vector of zeros and ones, where that vector of zeros and ones for any given property is +1 for any period in which the property is sold for the second time, -1 for whatever period the property sold for the first time, and 0 for any periods where the property didn't sell. And if you look at that, you can write that as a simpler looking regression essentially, because you can just write it as the sum of all of these betas, one for each period, multiplied by di tau, one for each period, one for each property, plus epsilon I. And so now, if you look at that, you can think about that as a regression equation where you basically regress the y's, the realized returns on the left-hand side, against the d's, the vectors of zeros and ones, saying whether you bought the property for the first or second time or did nothing. Just regress one or the other, and you get this. You get an estimate for the index every period. One thing to note is that you can do it using OLS, or this is heteroscedastic. If you look at the way we constructed it, you'll see that this is equal to the difference between these h's here, and this is essentially the geometric Brownian motion component, and so that has a variance which is proportional to the time period. But there's also, in this particular index, it's not in every index, but just to indicate that some of the things that Jacob is finding have been noted in other markets as well. There is this additional component, which is if you like to call it transaction noise, which is just additional noise that kicks in every time there's a transaction. One when you buy it, one when you sell it, and that will add essentially constant noise over and above the proportional part. An important thing about these repeat sales indices is that it's tempting once you've run this regression, you've got your index, you've now got this series. It looks like a price series, and it's very tempting, and people have been tempted to do this, to take the volatility of that series and say, oh, well, that's the volatility of real estate. When you do that, you get numbers in the sort of 5, 6, 7% range if you're lucky. The problem is that's not really the volatility of real estate. First of all, it's not really the volatility. It's not really even the volatility of a portfolio of real estate, because when you run this regression, you're automatically doing some sort of smoothing. But in addition, for a lot of the things that we want to do, we want to know about the volatility of individual pieces of real estate, not an index anyway. And even if there were no other problems with this index, the index is definitely an estimate of the price of an at least somewhat diversified portfolio, not an individual property. So we want to look at some other way of finding property-specific volatility and other moments of returns, and that's kind of where what Jacob does kicks in. So here's the null. The null is that property prices follow a standard geometric Brownian motion. And if we do that, then what's the expectation and the variance of continuously compounded returns over some random period tau? Well, one is mu minus sigma squared over 2 times tau, one is sigma squared tau. They're just both of them, the important thing is they're both just simple multiples of the holding period tau. What do we actually find in the data? This is the second graph that Jacob showed, but basically look at the dots. They're kind of the key thing. These are the expected returns, the mean returns over different holding periods. And again, it's important to point out that there are all sorts of, when you first think about doing this, there are all sorts of sort of calendar effects and so on that you might think might bias your results. But Jacob's very careful in the paper to take all of that into account. And this just sort of summarizes what you see. The main thing is mean returns don't seem to be particularly linear, although the standard errors get bigger as you get further out to the right. But it doesn't seem to be particularly linear, and it doesn't seem to go through 0. And the variance is basically the same thing, a little bit less nonlinear. But again, if you extrapolate down to 0, there's a positive variance here. So, okay, here's a slide that just says what I just said. So don't go to 0, and the intercept isn't 0. It's important to note that these results, and Jacob commented on this, do appear in other literatures. And I think this is important because actually it means that the results that Jacob is finding are actually more robust than you might, this is not just some particular artifact of the way NCREIF collects data or reports them, or, there's nothing specifically commercial real estate about this. Again, talking about Marco Giacoletti, who's on the market. I actually had the pleasure of discussing one of his papers in January. He finds a huge variance for individual, that's related to just doing the transaction rather than being time related. And I'm doing some work looking at sort of constructing alternative price indices with Nancy Wallace and a statistician called Chris Strickland. And we're finding the same thing. In fact, at the moment, the number we're getting for this transaction volatility is so huge that it's almost unbelievably big. So we're trying to work out what is wrong with our specification. But also note that in the standard repeat sales index, we had that extra N piece, so it's sort of well recognized that there is noise surrounding the transaction itself that is not related to how long you hold on to it. So that's the noise. Going back to 1995, Getzman and Spiegel have a paper where they suggest adding an intercept to the mean return to take into account the fact that they also noted that that there's not only a jump in the variance around each transaction, but there's actually a sort of there's a mean shift. The instant there's a transaction, if you transact immediately afterwards, the mean return won't be zero. Also, the non-linearities have also been noted, particularly for the volatility. So often, in fact, in running the GLS specification, rather than regressing the squared residuals on just time and a constant, often they'll put in, for example, squared terms to handle the non-linearity and the variance. So it's true, they're both real estate, but they're very different series, and you're seeing very similar patterns in what's going on. So what's driving it? Well, in residential real estate, unlike what Jacob is doing, there are actually structural reasons why you might expect to see these without really being particularly puzzled by it at all. And one of the big things is that the repeat sales indices only look at prices. And so if there's any, for example, remodeling, and certainly in San Francisco where I live, there's a lot of remodeling going on. I mean, it's pretty easy to find examples of properties where you've doubled the square footage of a property. That would just be treated as a return in the house price index construction. Well, so if that's the way you're doing it, then you're going to get both expected appreciation and variance just won't go to zero as the time interval shrinks to zero because you've got these jumps that are kicking in. The data that Jacob's using, it doesn't look like you can come up with such an easy explanation because it does include capital expenditures. Now, there's possible lags between when the transaction occurs and when they start repeating capital expenditures, but you drop anything with much of a lag. So that probably isn't what's going on, but might be worth thinking about a little bit more. The other sort of obvious thing that springs to mind is sample selection. Not that many properties sell in any given year. So maybe there's something about, and Jacob gave an example, but here's another one. Here's figure 1A. Those are the mean returns. Well, I could, suppose we buy a portfolio of properties. How long we got? 2 minutes. All right, I'll speak fast. I could follow a rule which is I will only sell my property when the return essentially hits the line formed by just joining all of those dots. Well, if I do that and look at the realized returns, I'm going to match that graph absolutely. Of course, when I look at volatilities will be zero because every sale that occurs at a given point will be exactly on that line. So it won't quite work, but I can certainly match at least some of it. And also, we think about how many observations will there be where I sell within 1 year, for example. Well, the likelihood with an actual diffusion process of getting a return of whatever it is, 1% in under 1 year, is basically going to be zero. So the distribution of the number of sales in a given year will also be counterfactual. So Jacob looks at this in the paper. I'm not completely sure that there isn't some. It might be an utterly ridiculous disposition strategy, but it might be interesting to see how can you find a strategy that matches the data. Anyway, the model. This is the nice thing. Unfortunately, I don't have that much time to talk about it. But coming up with a model in the spirit of, for example, Duffy, Garnier, and Peterson, some of these sort of search models of buying illiquid securities. So we've got heterogeneous investors. A little more discussion of sort of where the heterogeneity comes from would be interesting. Sales only occur when high-type investors meet low-type investors. That's kind of a critical piece of this. I'm going to have to go through this faster than I kind of wanted to, but that's life. The key thing is because the sale occurs when random types meet each other, the sales price depends on characteristics of both the market and the buyer and the seller. So that adds additional variability to transaction prices that's not just because of the whatever's driving the actual property characteristics. What is interesting is that, we've got, don't step over the line. We've got this model, and we've got different types, and there's some interesting dynamics of the model, which are just talked about in the paper, but Jacob didn't have time to talk about it, so let me just do it briefly here. Suppose there are heterogeneous investors, but there's no persistence in their types. Well, it turns out then your model won't work. And why won't it work? Well, because if there's no persistence in types, then the distribution that the original buyer was drawn from is the stationary distribution. Well, the stationary distribution, or at least a truncated version of the steady state distribution. The distribution that the new buyer is drawn from is going to be the steady state distribution. And so the distribution of prices at the original and the second date are going to be identical. When you factor in the fact there's a transaction cost as well, that means that you must have expected returns at short horizons being negative. Now, even if, let's add persistence, but only have two types, that would seem the natural thing to do. Well, if you have only two investor types, what happens? Well, unfortunately, basically almost the same thing goes on. With just two types, trade only occurs when a high-type investor meets a low-type current owner. And if you think about this for a moment, what it means is, again, the initial and the final selling prices must come from exactly the same distribution. And again, the transaction costs make expected returns negative at short horizons. I'm now at 0. So what it means is that, but with persistence and multiple types, now we can get there. Why do we get there? Well, because what's happened is the current owner is unlikely to. The issue is that there are two reasons why you might sell. So you've met someone with a higher type than yourself. It's either because they have a higher type than you originally did, or because your type has gone down, and now you've met someone that looks kind of maybe like what you were when you first bought the property. But over a short horizon, because of persistence, your type is probably the same as it was when you bought the property in the first place. So the most likely outcome, if you sell over a really short horizon, is that you've encountered someone with an even higher type than you were when you bought the property, and therefore the price that it'll sell at the second time through is on average higher than the first time through, and you get this positive alpha. And Jacob shows that you can calibrate the model to match both the behavior of the expected returns and the variances, as well as the likelihood of sales over various different distributions. The one thing I would be interested in is if you take the model seriously, so you've got high type investors and low type investors. High valuation investors today are likely to be high valuation investors tomorrow. And so what you should see is those investors should only be buying. Likewise, low type investors, if they have a portfolio, they're not going to be buying anything, they're only going to be selling. So it'd be interesting to just look at the data, and you ought to see buying sprees and selling sprees when you look at specific individuals or specific owners. You shouldn't be seeing what looks like, you won't see a lot of the same firm selling a property over here and buying another one over here. That shouldn't happen much. I mean, it can happen a bit, but mostly a given firm is either going to be buying, or selling for some period of time. It'd be interesting to see whether that actually matches the data. But yeah, so forget that. Doesn't really matter. So the overall, I think this is an excellent paper. It was quite hard to discuss because pretty much everything I could think of to throw at what he'd done, Jacob had already addressed and dealt with in the paper. I think it teaches us a lot of important things about the behavior of real estate prices. It's also a useful thing showing that these search models actually do have some practical value. And Jacob talked a bit about some of the things that you can get out of these models. And I think that this is potentially useful not just in real estate. I mean, I like the fact that this is useful in real estate, but I think it has a lot of potential applications in other illiquid markets as well. So please do read the paper and invite more real estate papers back for the conference next time. So thank you very much.